Welcome to the Masters of Real Estate. My name is Mathew Owens, a California licensed CPA and full-time real estate investor. And today I am going to be talking about the state of the California market and the state of California real estate with a good buddy of mine, David Coe, that focuses 100% on the California market, has been doing this for years and years in this market. And I'd say decades and decades to mess with him about his age compared to mine. But we always give each other hell a little bit when it comes to real estate investing and joking around. And Dave, thanks so much for coming on the line today. I really appreciate it. I'm excited to learn a little bit about what's happening here in California and the state of the market right now from what you're seeing, because you're on the ground, boots on the ground, seeing every single day what's going on in the overall market and seeing, changes in the rates, changes in the supply and demand and things like that. But first, can you talk a little bit about your experience investing in real estate as well as a licensed realtor in the market, and kind of how you help clients and your kind of long-term experience, man?
First of all, thank you for having me on. I've been seeing all your emails about all your stuff, so it was an honor to be asked to participate. I've been a licensed realtor going on 15 years now. But when I got my real estate license, originally it was just to do fixing and flipping with my wife. So that's kind of how we started in 2007. It was a great first year. Year two wasn't so good. But from there, I started learning a lot more about diversifying and getting involved in different things. And, over my career, I've been involved in everything from, non-performing notes. I've gotten involved a lot in some passive investing. I've invested with Matt, with you and some of the stuff in Memphis, either through different funds that I've been a part of or, recommending clients that invest with you. Currently, I do run a real estate team. I'm based in El Segundo. So the majority of our market's down in the South Bay of Los Angeles. But I'm also involved in some new construction projects, mostly small lot subdivisions, which are 2,000 square foot homes on 900 square foot lots. So, tall, dense,
Nice.
literally built 6 inches apart from each other. It's part of the Los Angeles County zero lot line ordinance. So, and then part of my team also specializes in selling new construction. So we selling one house versus selling 30 houses is a completely different process. So we specialize in that. And then I also run, I'm one of the owners of my Keller Williams brokerage. So I'm the day-to-day operating principal on that. And then Matt,
Awesome.
you and I run for Investors by Investors in the South Bay together.
Right.
We've been friends and investors for years, and it's good to finally get asked to be on your show. It took so long.
Yeah, I talk to you all the time, so I already get all the updates. So, and
Good
for those
point.
of you guys who don't know, For Investors by Investors, or FIBI, was put together by a couple of full-time investors to teach people about real estate investing, get the networking in there without a big sales pitch, just teaching, education. We have about 6 chapters throughout Southern California now, in different areas that just go through monthly meetings, teaching about every aspect of real estate investing and developing the relationships you need for this business. And so, and Dave, you have a different perspective than I do. I primarily invest out of state in different markets, even though I live here in Southern California, along with you. But in California can have a bad name, right, when it comes to real estate and what they do economically, as far as the controls on housing, the problems that you have to go through when you're dealing with new development, the problems you deal with regard to rent controls and things like that. But it seems like a lot of those things that occur at the government level really trickle down into a positive effect for the supply and demand metrics with real estate as a whole, from an investor perspective, right? Like, if you're limiting supply because you can't go through and build fast enough because it takes 2 years to get through an approval process, then you're limiting supply automatically by doing that, and you have a lack of housing, right? Same thing with the rent control aspect. Rents continue to rise over time. We talked a lot with one of our good friends, Anthony Walker, about this specifically, where he talks about what happens when rent control gets enacted with regard to rents historically. And what is your take on the overall market here in Southern California and the strength of the market as a whole? You know, even given some of these governmental factors that everybody else might cringe a little bit, but not realize what may actually be occurring because of those things to the overall market.
Well, I mean, well, there's a lot to unpack in that. First
Sure.
of all, there's a universal truth out there. We have a lack of housing everywhere, right?
Right.
Like underdevelopment isn't something that's unique to Southern California or California as a whole. I mean, Matt, even some of the markets that you deal with, right? Like there's a lack of inventory
Right.
everywhere. Part of that is a demographic trend, right? Like, you know, when we really look at real estate, you know, stepping back from the highest level, you know, right now we've got millennials, which is the largest generation in the history of mankind. You know, they are all turning 32 years old. They're getting married and they're having children and they're buying real estate, right? Like this is just part of the natural evolution that people have over their course of their lives.
Mm-hmm.
And then historically, in generations before them, we've had generations where people would either pass away in their 60s and 70s, and then those houses that they lived in would become first-time home buyer homes. Well, the baby boomers are living longer, they're living healthier, and aging in place has become the goal for most people when they age. So we're in a situation everywhere, and I would probably argue this is a global trend, not just a national trend, where older people are living longer, right? And the largest generation in the history of mankind is entering into their home buying life cycle, and there just isn't enough inventory. So, you know, that gets exasperated in California because of the politics and the steps that you have to go through. I mean, we are on a fairly active geographical fault system, right? And you see what happened in Turkey and Iran. And look, you know, I'm a builder. Trust me, it's frustrating. I literally got off a call this morning, Matt, with one of our inspectors that won't let us release gas meters because we put fences on the plans and we decided not to add the fences and we need to go back through planning. Right. Stuff
Wow.
like that drives you crazy. Right.
Right. Right.
But, you know, that's just that's what we do. Right. It weeds out a lot of people on the development side.
Right.
But, you know, when you look at the history of California real estate, especially Southern California real estate, it is one of the highest performing assets in the history of mankind. Right. If you think about where home prices have gone in the last 100 years in the state of California, you know, we've got one of the best climates in the entire world. We've got one of the most diverse economies in the entire world. I think California is now number 4. We just passed Germany, and we're hot on the heels of Japan. And the city of Los Angeles alone has like the number 5 GDP in the entire world from a city perspective, right? Diverse economies, you know, recession resilient, just based on the amount of diversity that we have within our economic engine. And there are people that are leaving California. You know, one study that I saw, which is a few years old, California was the number 1 out migration state, right? People leaving California, right. But it was the number 3 in migration state, right? Mm-hmm. So, you know, if you are a young attorney, if you're an aerospace engineer, if you're getting involved in the entertainment industry, right? If you're involved in shipping, right, manufacturing and port, and you're going to advance through your company's life cycle, more than likely you're going to spend at least part of your time in LA, right, or in San Francisco. If you are a startup, if you work for a tech company, you're probably going to end up in California. So, you know, if you are an engineer in India or Pakistan or China, right, and you want to work for JPL, you're not going to end up in Idaho. You're going to end up in LA, right? So we also get all kinds of international migration. Gotcha. So our population has stabilized. I did see an article that at one point people were predicting we were going to have 45 million people in the state of California by 2035. And now those projections have come down about 5 million, because it seems like our population is starting to stabilize.
Right.
But we still have a lack of housing, right? Day supply in my market that we deal with is still down below 60 days. So, while it's not a hot seller's market, it still is a seller's market. It's not a buyer's market. And prices have seemed to, obviously everywhere prices skyrocketed for 2 years.
Right.
We've certainly come down from the peak, which is about where we were a year ago. Last March, April, May was kind of the peak, depending on the pocket. We're probably down about 10% from that point, but we were up 40% in the 2 years before that, right? So we've just kind of given back some excess appreciation that we had.
Right. And I think that's, really good to note. And when you're talking about, the supply and demand aspects, understanding every single market is completely different, and realizing that, hey, yeah, there are metrics. If there's people leaving the state, maybe for political reasons or because of just affordability, quite frankly, in the housing market, you're still going to get a major influx, though, just honestly, because of the weather alone. It's just the whole reason I haven't moved out of state is because of the weather and family here.
Well,
But
dude, if I had $1 for every California person that bitched about leaving the state of California that still lives here, I wouldn't need to work anymore, right?
Yeah,
You
exactly.
included, Matt.
And I think you bring up a good point with the baby boomers sticking in place and the millennials coming into their prime buying years, and that being such a big influx. You have a reduction in supply over here and an increase in demand over here. And then you also have this big wrench that got thrown in with regard to interest rates and things like that, where that affordability got majorly squeezed to squeeze the market, which then reduced the demand further on that side of things. And then also, but they'll reduce the supply, right? Because you have a lot of people that are sitting there with 3% mortgages that they're not going to go trade up and sell at that point. So you don't have as many listings coming on the market simultaneously as a demand, and having to be a little bit more of a broken market at the, because that supply and demand is so suppressed at the moment because of that major rate shift that occurred. But what are you seeing out there with regard to, the supply and demand now versus historically? What would you consider a healthy market is with supply and demand, and what do you think it is right now that you're actually seeing out there with regard to supply and demand and days on market, stuff like that?
Yeah, typically a balanced market is a 6-month supply, right? So when you look at the health of a market at 6 months, that's where it's kind of balanced between buyer and seller.
Okay.
We at one point a year ago, Matt, I did actually Anthony's Phoebe Long Beach meeting, and we were down to a 21-day supply in January of 2022, right? So not only even 30 days, right? We were talking about days, we were talking about weeks supply.
Right.
And that now has doubled, right? So the supply has skyrocketed is the media headline. Well, yeah, it skyrocketed. It went up to 2.5 months. It's still, way below what we consider a balanced market. And
right.
You're right. A big component of that, we call it the golden handcuffs, right? 70% of all homeowners have an interest rate below 4% right now, right? So, what it's doing in our industry is, basically March, April, May of last year, we were on pace to sell about 6.1 million homes in the United States. So, right. So these aren't California numbers. These are national numbers. This year, I think our projected pace is about 4.1 million homes.
Okay.
So, we've lost about, a third of our transactional volume in the last year because of interest rates.
Right.
And, even right now we are trending lower. Who's selling? People that have to sell. No matter what happens, people sell. Death, divorce, distress, relocation, the size of their family grows. Like, those are still the people that we're kind of catering to right now, or people that are renting, right? Look, I know rates are high, or everyone's so freaked out because rates are in the low 6s. Well, historically, that's actually a pretty good moderate interest rate for housing.
Right.
And guess what? If you're renting, your interest rate is 100%, right? So if you want to talk about high interest rates,
and rents are rising like crazy still in Southern California because of lack of supply in the market. So, it's like pick your poison in that kind of situation. Should you buy or rent? It's a tough thing because your rent amounts are still unstable. They're not going to continue to. They may not go crazy high. Depends on what happens. But if the supply is low, rents are still going to be strong in that area. And I think as people get pushed away from housing due to affordability, they get pushed into being a renter as well, and that hurts that market even more with regard to the supply and that aspect. Now, we've seen, of course, across the nation, everybody says, oh, the sky's falling in real estate, but really we had like a 0.2% year over year decline overall, which is crazy. And if you look at what occurred previously with the amount of money that was printed into the economy and that major uptick up to the beginning of 2022 before the rates changed, and obviously we had so much money flowing into real estate, of course it's not sustainable to hit that kind of level. You got to come back down to some normal relative level. And now we're starting to see, some cracks potentially in the economy, and the consensus that maybe the Fed will do a pivot, and we're starting to see mortgage rates actually drop a little bit, so down further, maybe almost even a whole percentage point, maybe half a point to 0.75% of a point in some cases, depending on credit and where you're at and things like that. Are you seeing some of the cooling effects of that now, where the affordability aspect, it took a major hit, but now rates are starting to trickle down, maybe a little bit more demands coming into the market? Are you seeing that happen right now, or are you still seeing it break even? Because still 2.5 months of supply is crazy low historically, right? So it's interesting to see what your perspective is.
Yeah, I mean, so let's talk about rates. I think rates is probably, the where everything kind of starts and stops. And honestly, even before that, before rates is inflation, and maybe even before inflation is unemployment, right? So when I track, the market and where things are going, I kind of track things in that order, right? So every time we have a shitty jobs report, I just start getting gleeful, right? Because I know that's one of the first things that banks are looking at, right? Because they're trying to get out in front of the Fed, right? And then, then we had inflation, right? That was, starting to show signs of weakening. And then all of a sudden that had a kind of in January, right? All of a sudden it started to stabilize a little bit and rates shot up. So let me give you the history of interest rates for the last year. I think this is important. So a year ago, and by the way, I track this on the Fred. St. Louis Fred has a 30-year mortgage chart, which is my primary data source for looking at interest rates. I think it's compared to the actual buyer loans that we see lock in, I think the rates that we're actually seeing buyers lock in are most similar to what this Fred chart shows. We were down into the high twos at one point, 14 months ago. Rates then slowly started to climb. In November of last year, the Fred showed it at 7.09%, right? So that was the peak. Which when rates went from 3% to 5%, everyone freaked out, right? And then when they went from 5% to 7%, everything just stopped and paused. Last October, November, December are 3 of the slowest months that I've ever had. Now, luckily, I've got some new construction projects, and some of those deals kind of, the new construction's different than the typical homeowner. Typical homeowner can just sit back and wait it out. Builders can't. They've got high interest construction debt on. They have to sell it now, and if they have to make price concessions, they make price concessions. And then so we kind of peaked at in that 7.1 number in November. And then all of a sudden, inflation showed signs of cracking and breaking. And then interest rates started coming down, and we got down to about, in the low sixes. And then that January report hit on inflation, and the numbers, all of a sudden, the interest rates climbed back up almost into the high sixes. And then, Silicon Valley Bank and First Republic, and, when we had the banking issues, ever since then, we got about a 4-week run now where now rates are kind of back down into the low sixes. And most of the people that we're following are projecting that, all of a sudden, probably the best thing that could have happened to our economy, Matt, is having these banks, stabilize and, fail, right? Because now all of a sudden, The Fed is kind of, signaling they're going to pause on interest
Right.
rates. That means, look, that's all the mortgage companies need to know. So interest rates have been falling. And I think when we went from 3 to 5, the market absolutely stalled, right?
Mhm.
But when we go from 7 to 5, all of a sudden, right, buyers have a short-term memory.
Right.
They're all of a sudden going to rush back in. And we're starting to see that right now. We've I think in the last week, we've opened up about 8 escrows on different properties, some of it new construction, some of it just regular resale, work that we do. So we're definitely entering into the buying season. It's not that rates are super low, but they are coming down.
Right.
And, one of the biggest things that we counsel our buyers on is the fact that a mortgage is a temporary thing, right?
Right.
You can always refi out a mortgage if rates continue to drop, right? So, the mantra that we teach our clients is, you're going to date the rate and marry the house. Prices have come down, from a year ago, and
Mhm.
you said 0.2%. I think in LA it's probably more like 10%.
Right. In LA, I was talking nationally,
LA.
right? Yeah.
Yeah, nationally, I think you're right. And and I saw something that really LA, the West Coast has been pretty flat. The Northeast has been pretty flat. Prices have really, they've actually gone up in the Southeast, right? Because there is a lot of migration going,
Right.
Texas through Florida and Memphis and some of the markets that you do business in. So those prices have actually gone up, which is what's kind of making the national rate seem
Right.
pretty flat. But we've definitely seen a decrease in pricing from the peak, and we've now got a decrease in rates. So, seasonality is kicking in, and we've gotten really busy over the last, 3 or 4 weeks.
Yeah, I think looking at the specific markets is extremely important because especially the ones like a California, like an Idaho, like an Arizona, like, some of these markets that had peak affordability issues already, because the demand was so hot in those areas are now going to be the ones, of course, they're going to take a little bit bigger of a hit when the rates, adjust like that in those situations. But, also within those markets, like California, you can't just say California. It's like 5 nations in one state, right? So,
It's
you got
true.
San Francisco that is a completely different market than LA. Orange County is a completely different market than LA. San Diego is a different market than LA or San Francisco, right? Like you have these segments of the areas that kind of function independently of each other, of course. And you also have different segments of property values, right? You have your starter homes, which in California is like maybe like a $700,000 home or less now, and
Mhm.
then you have the middle market homes, and then you have the really big mansions and stuff like that out there as well, and the
Which,
bigger
which,
homes.
which,
Are
by the way,
you?
Matt, I haven't done the research on this, but I bet you if you cut California by price segment,
Uh-huh.
right, 1 to 2 million in LA probably looks a lot like 1 to 2 million in San Francisco, right?
Okay.
Like,
Hmm.
again, I think it's more of a demographic thing, right? Where
Right.
who's buying right now
In the
is
areas.
first-time home buyers, right? So people
Right.
that are 1 million or lower is an active price segment versus if we were to look at I actually did we've got a listing presentation next week for a property, a hillside property. It's going to be probably, plus 2 million. The average day supply for the comps in that area are close to like 170 days,
Okay.
right? Versus the average day supply for a $775,000, single family starter home in Torrance is
Hmm.
probably 2 weeks, right?
Yeah.
Where
Yeah.
we wrote an offer on a property in Compton, $750,000 Compton. One of my agents wrote that last week. She got outbid. There were 19 offers on the property, right? So
That's
we
crazy.
still have that level of intensity and volume in the lower ends, but I think the upper end, which are the people that are locked in at 3.2% interest rates, they don't need to go anywhere. So they're just going to kind of sit back and wait and see what happens until something happens. They have to downsize. They need to move out, right? They get relocated. They finally do the thing they say they're going to do, and they move to Texas and get rid of crazy California politics, right? But they're not going to do it right now. They're just going to hang out, enjoy the weather, and wait for the rates to adjust.
I'm glad to hear good things are happening in Compton. I'm actually from Compton. Actually, my dad was, so I get to claim Compton too, of course. So,
Dude, I'm telling you,
so
Southwest Compton is like Northwest Gardena right now.
yeah,
There's
there you
a lot of
go. Yeah,
pockets in there.
nice. And so are you seeing changes in the asset values more so on the high end stuff and the medium stuff and the starter home stuff? Where are you seeing the most volatility and the least volatility within those types of asset classes?
Yeah, I think that the higher end stuff has just had less activity. Now, look, there's been a couple of unique things that have done that, right? So the city of LA passed a tax that anything over $5 million, you had to pay an additional half a point, 1 point
Mhm,
percent tax on those proceeds. No, I think it's
mhm.
2%.
Yeah,
So
I think so.
we did have a huge, I shouldn't say a huge, but we definitely saw a surge and activity on that $5 million plus level the beginning of this year. But I think
Mhm.
that's going to kind of stabilize out. But for the most part, I would say that $1.5 million price point and down has been pretty normal. And we're
Okay.
still seeing activity and transactions. And when you have a house in Compton with 19 offers, more than likely prices are going to be rising in similar areas, right? Because those 18 people that didn't get the home are still continuing to shop.
Right.
But on the upper end, I think that's where you're seeing prices are probably being affected more. And a 10% hit on a $20 million house is a $2 million price correction, right?
Right. Right.
Versus a 10% drop on $1 million house, right, is only $100,000.
Right.
So
Right.
I think that's where you start seeing some of the numbers
Gotcha.
kind of balance out and kind of move to the mean. But for the most part, I would say that the lower end of the market, which in California is still expensive, it's $1 million and
Right.
under, is still a very active real estate market right now.
And are you seeing people, because of the affordability squeeze and, maybe wages not keeping up as up as affordability squeeze was with the rate change on the property values? Are you seeing people not qualify for financing right now, or are you kind of dialing that in? Is there any uptick in people not qualifying in your eyes from what you're seeing?
No more
No.
than normal, Matt. I
Okay.
mean, but look, here's the thing that California does have, right? We've got a lot of young millennial high paying professions, right?
Mhm.
So, the area that I mostly deal in Southern California, which is a lot of aerospace, and then of course, the South Bay, which is a lot of aerospace, a lot of professional services, so attorneys,
Okay.
medical professionals. And then the new construction stuff is up in the valley. We deal with a lot of entertainment clients, right? So those industries have still been pretty robust. And, we might not be approving, we don't have a lot of people that are buying with 20% down. We actually had an all cash offer come in today from someone on one of the new construction houses. That's not as common as it used to be. That's a
Right.
little rare. But we have a ton of people putting 5% down, 10% down. This new Cal Halfa program that you and I were just talking about that lasted for almost 5 days,
Mhm.
because that money went so quick. I mean, those kinds of buyers right now are still insatiable, right? Because they
Right.
know they're renting and they know they're, the signature piece of any one person's financial wealth plan is your own home, right? And when you can start building equity through your own home, it kind of it gives you your first big chip on the financial
Right.
wealth building game board. So those people are still trying to get out of their rental situations and into home ownership. And we haven't seen any serious change in approval rates. Just maybe more the amount of people that are in the market has certainly come down as rates have gone up.
Gotcha. And speaking of building wealth through real estate, from the investor perspective, it's very difficult to get properties to cash flow in Southern California, for example, and a lot of markets in California, just because of the rent to the price of the home is so low in comparison. Even though rents are rising like crazy and things like that, you're still talking about, a very low rental price ratio, which means a low cash on cash return if you were to even buy all cash. And it doesn't really work with the financing, aspect of things in there to get something to cash flow unless you're putting 50% down, in which case your return on investment just isn't that great. What are you seeing out there that people are getting creative with regard to California real estate that can potentially juice cash flows from an investor's perspective? So, I know with the housing supply issues and stuff like that, it's difficult, but how are you seeing people bring other units on and being able to increase their cash flow at the same time?
Well, let's talk about IRR first, right? Because IRR is important, right? You mentioned cash flow, right? But you
Yeah.
have cash flow is one segment of IRR,
Yeah.
right? People don't
Internal
buy
rate of return. Right.
internal rate of return, right? Which includes all kinds of things, right? It includes your ability to cash flow. It
Mhm.
includes the some
The
people will
principal
consider
reduction.
the tax benefits that you get from that,
Mhm.
right? It's the equity buy down you get with you're paying your mortgage, and the biggest piece is appreciation,
Mhm.
right? When you're in California, you're not a cash flow investor, right? You will become one
Right.
eventually. It doesn't happen right away. You're an appreciation investor, right? So
Mm.
the difference between buying a piece of property in Torrance versus buying a house in St. Louis is that you're probably going to end up making the same kind of IRR over a 10-year period. But in California, you're going to see that more in appreciation and less in cash flow,
Mm.
versus in St. Louis, you're going to see that more in cash flow and less in appreciation, right?
Gotcha.
So I think it's important for an investor, that's coming in. If you are a pure cash flow investor, right, and you need cash flow now, California is not the place for you to be,
Mhm.
right? But that's not who invests in California. People that invest in California are more people that are looking to acquire assets that are going to appreciate in the long run, right? Appreciation gives you all kinds of benefits, right? The greatest being the cash out refi, right? Which is my favorite tax strategy, 0% tax on a cash out refi, right? So building assets, creating appreciation, and pulling money out to then buy more assets is the game that California real estate investors play that might
Mhm.
be different than cash flow investors that are outside of California. But at the same time, there are ways of strategically structuring an investment to create cash flow. The number one reason, number one way people do it, Matt, is you're right. People will put down 50%,
Mhm.
which again, they're not going to get a huge return on equity if you just look at the cash flow. But if you consider the IRR they're going to get over a long period of time, they're still going to do fairly well on that investment. We've got a lot of people that are putting in ADUs right now, or accessory dwelling units, which I think the kind of the street name are like granny flats or in-law suites, or
Mhm.
things that used to kind of happen bootleg for many years. California passed a law a couple of years ago that now makes these ADUs legal,
Mhm.
which can be everything from ground up new construction on a small little single family home, to converting a detached garage, to converting an attached garage, to
Mhm.
adding a tiny home into your backyard.
Right.
So I think a lot of people that are investing in California, what they're looking to do is somehow add a unit into the mix to help their cash flow.
Right.
And one of the perfect examples is, we've got a good client of ours that was buying duplexes that had a detached garage. He'd buy the duplex, he would convert the attached garage into an ADU, turn it into a triplex, and the amount of money he would spend to convert a garage would basically break even in about 3 to 4 years, depending
Great.
on the complexity of the,
25 to 33% return. That's pretty amazing.
right?
Oh,
And then all
right.
of a sudden, after year 4, your basis on that unit is zero, right?
Mhm.
And then, by the way, the rents on your other 2 units probably went up 5 or 6% because
Mhm.
rents are going up. So, if you can break even right now on the primary unit and then start creating cash flow on the third unit, that's a
Mhm.
strategy that a lot of investors are using right now in California. And we've got 2 or 3 clients that are chasing that very strategy.
I'm seeing it in different neighborhoods right now consistently, where they're taking, a bigger unit and cutting off like a game room or something like that, creating a second unit, and then converting the garage also to make one single family house up to 3 potential units as well.
Mhm.
And being able to look at the detached secondary ADU as well on top of this. So it's interesting what you can do now with the new laws in California that are allowing you to build these additional units to help solve some of the housing supply issues. And with the way rents are right now, you can basically get a great return on investment in cash flow just from separating these out and being able to add additional units onto your property to make something actually work, right? I'm especially if you were able to go into certain cities that already have done the ruling on short-term rentals and things like that, to be able to do that. Of course, a lot of cities or don't like short-term rentals, or they have permitting, things and things like that you have to do. But being able to go do that and rent these out as short-term rentals in different ways to really juice cash flows can work as well, depending on the city that you're seeing. I had actually thought about a plan where I would go out to all the different homeowners and help finance ADUs on their properties, because I know that it would pay for their mortgage long term after the financing payment and things like that, and develop a marketing plan specific for that, because there's a massive need, right? And every time you can fill a need in a market, you can make money, in with those specific needs, right?
Yeah, and
And
Matt, but before we lose that thought, because I think you said something that was really important,
yeah,
that's different from California than maybe investing in other markets, right? What you're not going to do in California is a cosmetic fix and flip
right,
or a cosmetic value add. You can get away with that in other markets, right? Because maybe the landlord didn't have the rents, as high as they should be. You could buy it and just raise the rents. You can't do that in
right.
California because of rent control, right? Right. You can't. The pricing here is so expensive. So the way to succeed in investing in California is you have to add value. And if it's ground up new construction on an ADU, if it's converting, if it's bumping out a house, right? The downside is that our cost per square foot, even in moderate areas, are $500 or $600 a square foot.
Yeah.
And while construction is higher here, it might only be $200 to $300 a square foot to build, right? So
Mhm.
right there is that $300 a square foot spread you can get
Huge.
by adding a bedroom or
Right.
adding an ADU or a JADU, or we've got one of my builder clients, a year and a half ago bought a 12-plex, right? So it was a 6-unit and a 6-unit side by side. They had a shared driveway,
Mhm.
and then they had six garages, single car garages in the back. Well, they bought that. They ripped down the garages. They rebuilt the 6 garages and built 2 new ADUs or 4 ADUs on each property.
Wow.
Well, it took him forever. DWP crushed him. But
Yeah.
now that he's done and he's rented, his cash on cash has skyrocketed because he added 4 brand new units, and the new ADUs rent for more than the existing units that he bought, right? Because they're new construction.
Right.
So there's ways to make money in California, but it's the long-term game. It takes
Mhm.
time. You
Right.
have to be patient. And if you need money quickly, this is not the place to go. But if you have time, then you can make a lot of money investing in California. You just have to take on, some more complicated projects and be patient.
One thing that I wanted to discuss with you on this was the because you have all these people with low interest rate mortgages that are locked in place, and then you have a lot of sellers that maybe they haven't come down to expectation of that 10% dip, or 5% dip, depending on the area, of values yet, and they're sticking to their guns and trying to sell it for top dollar. I'm looking at opportunity here and saying, is there an opportunity to be able to, and I'm curious if you're seeing this or not, maybe an opportunity to come in and purchase properties subject to the existing mortgage that's in place,
Hmm.
and get seller financing from the current sellers, that maybe are just squeezing their dollars because they want to get that top dollar. Because a lot of times, as a real estate investor, you can come pay them their price as long as you get terms on that asset, and even if it's a little bit above market, as long as you can get that 3% mortgage in place or 4% mortgage in place and hold that long term, it could still make sense to be able to acquire that way. Are you seeing any uptick in that activity at all, or is that still really rare, or where you're not
It's
seeing that happen?
it's still pretty rare. And it's funny. I actually had I had someone throw a duplex across my table the other day that had a 3% assumable interest rate. And I
Nice.
started doing backflips. But guess what? The person that got the 3% got it because they were owner occupied. I'm non-owner occupied. So I cannot assume an owner occupied rate for an investment property. So
Interesting.
even if you have an assumable rate, which are rare, right? Chances are you won't be able to assume it because you're an investor and not going to live in the property yourself. I
Gotcha.
think the seller financing is a better option, right? So someone that has a low basis on the property, which look, that's another thing that the last, 2 years has done. I think 50 to 60% of all homes in America have over 40 to 50% of equity in them right now.
Hmm.
So, and there's a lot of properties here in some areas where there's no debt, or maybe there's a $50,000 loan still on it, right? So if you can somehow pay that off and then do seller financing for the rest, I
Hmm.
think there is opportunity there. And look, obviously, Matt, you know better than anyone on how you can use debt to create opportunity. 40-year mortgages, interest only, right? And
Right.
there's ways that you can benefit the seller from a tax perspective because you can kind of spread out their capital gain hit. I think there absolutely is opportunity on the seller financing side, but I don't see as much on the assumable rate side, because there's
Gotcha.
less things to deal with. And then even then, the low rate that you want to assume is an owner occupied, not a non-owner occ rate. So it's not going to work anyway.
And I see what you're saying. And one of the strategies I utilize when I'm taking a property over subject to is, dealing with the risk of the due on sale clause in itself, where if they call the loan due, then, I can transfer the property back to the owner and still have them make those payments and do a land contract or something along those lines to where they can still keep that loan in place and, take the risk on of that due on sale clause that could occur in the first place, or have them put it into a trust or another format where you can control the trust in a different way where they continue to have title. It's not illegal to do that. They just have the right to call that loan due if you don't disclose it to the bank, of course. And of course, you want to be very careful and mitigate that risk as best you can and have the capital to pay that off if something really bad was to happen, which of course most people don't have that ability to do that, of course. So it just looks like a big of opportunity for me and for a lot of investors out there that might want to be able to try to take over properties subject to, but there's some hair to it. You got to be really careful, get your attorneys involved, make sure you're not doing anything stupid that's going to cost you a bunch of money later on. So, Dave, this has been,
Which is why I like the seller financing. It's
yeah,
clean, it's
it's a lot
easy,
easier.
right?
Right.
And it's a note, right? It gives them the ability to sell the note if they want out sooner than later.
Mhm.
So yeah, I think that it's one of the things that we're looking at, because there are ways you can find older properties that have very little amount of debt on it, and then
Right.
see if you can approach and acquire through seller financing.
Gotcha. Awesome. So this has been awesome, man. I really appreciate all the detail on this and the going in and out of the supply and demand aspects of the California market, and getting your expertise about what you're really seeing out there. If people want to get a hold of you to get more information on the California market, or maybe they're considering buying here or investing here in different ways, how can they get a hold of you, man?
Email's best. So send it to David at CoRE Group, and you can see it here in my name, COERE Group.com. Send me an email. I'd love to, strategize with anyone. And look, as we kind of talked about today, I just don't invest in California. I have invested in other markets, and having that conversation with someone about, look, what makes more sense for them. One of the basic tenets that we have is that every deal is right for someone and wrong for someone else,
Hmm.
right? And understanding what exactly is the reason why you're investing, and then finding real estate investment assets that fit your strategy, is a conversation that I'm really good at having. So if anyone ever wants to have that kind of conversation, not just about investing in California, of course, if you want to invest or buy in California, we'd love to help out. But if it's just a general conversation on investing and trying to understand the landscape and what makes the most sense, please feel free to send me an email, David at coregroup.com, and we'll set up a time to chat.
Awesome. Thanks a lot, man, for your time today. Really appreciate it.
Got it, Matt. Thanks for having me on.